So welcome class. We are to discuss this ATD level 1 August 2021 paper. It's ATD level 1 August 2021 Introduction Financial Accounting paper, and we are going to tackle question 2. Question 2. So this is our question 2. Explain the following terms as used in presentation of accounting information: dual aspect, then materiality, and then going concern. And then that is part 1, that is 2A. Then 2B, the following information was expected from the books of Moria. We have that information, and we are expected to come up with the sales ledger control account as at 30th June 2021, and also come up with the purchases ledger control accounts as at 30th June 2021. So we'll start with part A of the question. That is question 2. So explain the following terms as used in presentation of accounting information. Explain the following terms as used in the presentation of accounting information. So dual aspect. Dual aspect is also called duality, the concept of duality, or double entry. And it basically says that any transaction in accounting, any accounting transaction basically has two effects. Will have two effects. And the effects will have two effects, which are going to be recorded in either the debit or the credit, which can either be recorded as either debit or credit. So they affect either the debit side of the account or the credit side of the account. Any accounting transaction will have the effect of affecting the debit or the credit side of the account, and it affects differently. It depends with the type of the transaction, but that is what the dual aspect is all about. It states that every transaction requires to be recorded in two different accounts, and that is the debit or and the credit side. So for example, if we are talking about assets, an increase in asset is a debit entry, and a decrease in asset is a credit entry. So if cash possibly is used to pay to buy a motor vehicle, then motor vehicle will increase, it's an asset, so we debit motor vehicle account, and then we will credit cash account because cash has reduced. That is the whole concept of duality or double entry concept, that every transaction will have its effect on the debit and the credit side of the account. Then we have materiality principle. Basically says that we should not leave out any transaction unrecorded that can influence the decision making process of whoever is going to use the accounting information. So anything that we think is going to be significant, will have an impact in the decision making process, is considered as material, or and if it doesn't have any impact, then it's considered as immaterial. So we have sometimes when you prepare books of account, you may realize that you've left out one or two things, and the question that we'll be asking ourselves is it significant to affect the decision making ability or process of the decision maker? If yes, then we say that it is material, and so we must include. But if it's not so significant to affect the decision-making ability or process of the decision maker, then we say it's insignificant or it's immaterial. There are some transactions that are very small in nature that may not affect the decision-making ability of whoever the user of the accounting information is. Such like we say that they are immaterial. They may not be significant in any way to affect or to change the decision that will be arrived at by the decision maker. So materiality is about the significance of the decision and the ability to influence the decision making process or results. And then going concern, so this is about significance. Then going concern is about the perpetuity of existence. the assumption is that when we are preparing the books of account, we assume that the organization will be in perpetual existence. It's not going to stop production or its activities anytime soon. So this is basically the assumption that allows us to come up with other principles like the accrual concept. We talk of the things like especially the accrual concept. The ability to carry forward an expense or an income so that possibly will be received in the following year, or it can be paid in the following year. It's because of this particular concept, the going concern. It's basically assumes that the business will be in operation for an unforeseeable period of time. It will continue to be in existence for as long as it takes. So that is what the three items are majorly about. This is duality or double entry concept, and we are talking about debit and credit. This is the significance of the transaction in question, whether materiality is the significance of the transaction in question, whether it can affect the decision-making ability or not. If it can, then we say it's material. Then going concern is the assumption that the business will be there to stay for as long as it takes, and it doesn't plan in any way to close shop anytime soon. Then question 2. The following information was extracted from the books of Moria traders for the month of June 2021. So balance as at 1st June 2021, we have the purchase ledger credit balance, and then the sales ledger debit balance. Then transaction during the month of April 2021 was as follows. Payment to suppliers, 6,400. Total receipts from customers, 12,100. Discount allowed for 90. It's important to draw this line so that to avoid confusion. Sometimes we pick these figures wrongly when we are when you are in an exam setup. So it's always good that you draw these lines so as to just avoid cases of picking wrong figures for a certain item. Now we can see we know everything, how it goes. So that is good. That is the question. I hope you've been going through as I draw the lines. So what you are required is to come up with the sales ledger control account as at 30th June 2021, 7 marks, and then come up with the purchases ledger control account as at 30th June 2021. This is not a complicated question. It's a very simple question, straightforward question. So we'll just come up with a ledger. A ledger has the debit and the credit side. So we'll call this one the sales ledger control account. Just write sales ledger control account, that's enough. Debit side and credit side. Of course, you can restrict the zeros and show the units, currency units. So like that. And then we go back to the question and we try to pick anything that will basically qualify to be included here. Now the rule is very simple. Sales ledger. In sales ledger control account, we are talking about the debtors. We sell to the debtors. So sales ledger is about the debtors. We have so many debtors, so we just want to check on the accuracy of these so many debtors. A control account simply shows the accuracy. So these are the debtors. So we have data A, data B, data C, data D, data E, data F. Now the control account will show a summation of all these data. So you are actually taking the total of all the data and putting them in one book, which is called the sales ledger control account. And the information that will be used to feed this or to get to basically fill this is gotten from the day books. Some of the day books that we have include the return inwards day book, return outwards day book. We have the sales day book, a book that is used to record all the sales that have been done on a credit, Then Then we have purchases day book, Then we have cash book. This is also cash book. Will have the discounts, the bank column, and the cash column. No. So these are majorly the day books that will help us fill the sales ledger control account and the purchases ledger control account. And we take these figures from here in totality to check the accuracy of the personal ledgers that we have raised against all these data that we have. So instead of using the data that we already have, we go to the source document, the day books, and collect the totals from there, and it's those totals that we use here to post in our sales ledger control account. Now, normally we'll have two balances at the beginning. We might either, it depends, we might have like sales ledger, we might have the debit balance and the credit balance. Credit balance will appear when there's an overpayment maybe by the customers, then we'll have a credit balance. But if it's just normal, we expect the balance to be on the debit side. And then, of course, we go on and fill all the other information. So let's go straight to the question. The following information was extracted from the books of Moria traders for the month of June 2021. Balance as at 1st June 2021 is that balance purchases ledger 800. We are preparing the sales ledger. So this one will leave out. The purchases ledger will leave out for some time. Sales ledger, it's a debit balance of 560. So we simply come here, check the debit side. We will not talk about the debts. So we'll simply say balance. We'll talk of balance brought down. The amount is 560. So if they will have told us that the debit balance is 560 and the credit balance in sales ledger is say 200, then we'll have come here and say again balance brought down 200, like that. So balance brought down is 560, and then anything that increases the debtors will be on the debit side, will appear on the debit side, and anything that reduces the debtors will appear on the credit side. It's as simple as that. Anything that increases the liabilities of the debtors, will be on the debit side. Anything that reduces the debtors will be on the credit side. That is the whole guiding principle. So let's look at this. These are the transactions. Payment to suppliers. Suppliers don't have anything to do with the debtors. Suppliers will transform into creditors. So we leave this one out. We'll go to the purchases ledger. Total receipts from customers. Customers are our debtors. We are receiving money from our debtors. The assumption here is that these are just receipts from customers to whom we had sold on credit. So unless if the question specifies otherwise. So let's assume that. So total receipts from customers 12,100. So we'll simply come here and say receipts from customers. Of course, this one reduces the debtors. Receipts from customers 12,100. It would have been better if we would have talked about receipts from the debtors, or receipts from I think receipts from accounts receivable, receipts from debtors. This can show that these people, we had sold these goods to them on credit. So total receipts from customers 12,100. Discount received. Discount received has nothing to do with the debtors, because it is the business that receives discounts from the suppliers. We receive discount from the suppliers, and suppliers will transform to creditors if we don't pay for their goods on in cash. So discount received, this one will leave out. It affects the purchases. This one also affects the purchases. Discount allowed. It is the business that allows. It allows the business. We allow discount to the customers. So it is the customers who receive discount. The business allows. We are maintaining the books for the business. So business allows, and because we allow, no, what that means is that the customers will receive discount, so they will pay us less. So that has the effect of reducing what they owe us, what the customers or debtors owe us. So we'll simply say here, discount allowed, discount allowed. It reduces the debt. We have allowed them. They were supposed to pay us 200, but we allowed them a discount of 50, so they are supposed to pay us 150. Are you seeing? We are reducing the debt by that amount that we are going to allow them as discount, which is 490. So 490, like that. And then we go to the next item, purchases. Cash purchases. Purchases, we don't have anything to do with cash purchases for now. Let's concentrate on sales. Credit purchases, this one we leave out. Cash sales. Now, cash sales is you can see we have sold in cash. So if we've sold in cash, does it have any place in the sales ledger? No, because sales ledger only records what? Credit sales that have been made on credit. So this one doesn't, actually cash sales, leave it out. It doesn't affect it's not captured in the sales ledger or even purchases ledger when you're talking about the cash purchases. So whenever you see cash sales, this one is just basically it comes in as to confuse you, but it's not one of the items that need to be considered when we talk about the ledger control accounts. So credit sales, of course, credit sales has the effect of increasing the debtors. We've sold to them on credit, so the debtors will definitely increase. So we talk of credit sales. Credit sales, how much? 17,500, like that. Then we go to cash refunded from credit suppliers. Now, cash refunded from credit suppliers. This again is suppliers. Anything supplier, leave it. So that one, let's not think about it. Return outward, return outward. It is us who return the goods to who? We return the goods to the suppliers. We return the goods to the suppliers. The books you are maintaining are for the business. So return outward. It is us who are returning the goods outward. So this one also affects the suppliers or the purchases ledger. We are not going to deal with it here. We are only interested in the sales. Return inwards. Return inwards. It is the customer who return the goods to us. For one reason or the other, they return the goods to us. So when they return the goods to us, of course, that has the effect of reducing their liability. So return inwards. We said anything that reduces their liability, we simply credit. So return inwards, how much is that? 250. Then we have increase in allowance for doubtful debts. Increase in allowance for doubtful debts. Anything, whether increase or decrease, doubtful debts, that one doesn't have space in the ledger control accounts. What doesn't have space in the ledger control accounts are, number one, cash, either cash sales or cash purchases. Doesn't have space in the ledger accounts. It should not be entered in the ledger control accounts. Cash sales or purchases, that one doesn't have space in the ledger control accounts. Then the bad debts recovered, they also don't have space in the ledger control accounts. Bad debts recovered, those ones you see them, ignore them. Then increase or decrease in provision for bad debts. This one also doesn't have a place in the ledger control accounts. You see these items, just keep them. They don't have any place in the ledger control accounts because they are not even, like this one is not even captured in the sales, in this sales label that we mentioned. Instead, it's captured in the general ledger. Okay, so let's proceed. So this one we are going to skip. Increase in allowance for doubtful debts, that one we skip. This one will not be captured here, doesn't apply to ledger control accounts. Bad debts written off. Bad debts written off, of course, that one has the effect of reducing the debtors. It was a bad debt, but now it has been written off. This one has the effect of reducing the debtors, and it's 30. So we write it like that. Contra settlement. This one is going to be sent to the purchase account. Contra settlement means the same. We have one client as a debtor, and the same client as a possibly creditor. So we are offsetting. We're offsetting. So it appears on both sides. We offset his debtor account with the credit account, like that. So he buys goods from us, and we also buy goods from him. So in such like cases, we'll have these contra settlements. So contra settlement, we charge this to his account. Contra settlement, it's like he has bought goods from us, or we have sold goods to him, but then we are charging to his other account, the purchase account. So contra settlement, this is 850, we'll have it there. And then the dishonored checks included in receipts. Dishonored checks. So dishonored checks, they had been paid. We said any payment, when the customers pay, they are reducing their liability. And that will mean that it appears on the payment, will appear on the credit side. But now they had paid, and then these checks are dishonored. So it means their liability goes back to where it was. So it goes back to increase. We had paid, we had reduced, but the checks have been dishonored. So we simply go back to the same position we were. So this will be captured in the debit side to show that we are increasing again their liability by the amount in question, which is 210. Then interest on overdue debts charged to debtors. Interest on overdue debts charged to debtors. It means that the debtors already have overdue debts, and so we are charging interest. This has the effect of increasing on their liability. It increases on their liability, and because it increases on their liability, we post it on the debit side. Interest on overdue debts charged to debtors. So this is 140. Then refund to cash customers. Refund to cash customers. I choose to leave this one out. I choose to leave this one out because we are talking about cash customers. So if it's refund to cash customers, I think let's leave it out, because these cash transactions, we are really not interested. So if they are cash customers, otherwise we leave it out. Otherwise, if it was just refund to the debtors, possibly we will have that one will have the effect of also increasing their liability. It will have the effect of increasing the liability, but let's leave it out because the question is very specific. Refund to cash customers. Remember, we did not include the cash sales. So this is cash customers. So let's leave it out. So the next thing is bills receivable. Yeah, bills receivable will have the effect. This is just like a payment. Bills receivable will have the effect of reducing the debtor's liability, and this is 330, like that. So then, what do we do? I think we are done. We get the totals here. We get the totals here. The side with the highest figure will be our balancing figure. So let's get the totals. So this is 560 plus 17,500 plus 210 plus 140, that is 350. That gives us 18,410. We'll also add the other side and see the side with the highest figure will be used as a balancing figure. So this is 12,100 plus 490 plus 250 plus 30, that is 280, plus 850 plus 330. That gives us 14,050. So it means 14,050 minus 18,410. 18,410. That gives us 4360. So it means here you have 4360 and here you have 18,410. So these are closing figures 18,410. The difference, this gave us 14,000 something. The difference is 4360, and we'll call this balance carried down. So the difference is balance carried down. That is 18,410, which is a balancing figure, minus the total of this, we get 4360, which we call balance carried down. And this is on 30th June. 30th June, if we are written the dates, so that on 1st July, we will have balance brought down of what? 4360, like that. So that's how we go about the sales ledger control account. That is the sales ledger control account. So let's prepare the purchases ledger control account also. Purchases ledger control account. So this one will also prepare something like that. We have the debit side, we have the credit side. Shillings, we restrict the zeros. Shillings, restrict the zeros. Then we have purchases ledger control account. Purchases ledger control accounts. And then we'll start following the instructions that we've been given. So purchases ledger credit balance of 800. Simply come here and say balance brought down or forward. Balance brought forward, or how much? 560. 560, yeah? Not 560. 800. Purchases ledger is 800 credit balance. 800 credit balance. 800 credit balance. And then we move on. Now this one will be, let's talk of brought forward. It's actually supposed to be brought forward. Balance brought forward from the previous month. So this one will also be balance brought forward from the previous month. Sorry for that. Balance brought forward. Then go to payment to suppliers, 6,400. Payment to suppliers. The rule here now, these are creditors. Purchases, creditors, you are the ones who buy, the business buys from suppliers, and then these suppliers, if they are not paid immediately, now the relationship becomes that of a creditor relationship basically. Creditors are a liability to the business, and so it's a credit account. Anything that increases creditors, we credit. Anything that reduces creditors, we debit. Anything that increases, we credit. Anything that reduces, we debit. So let's go back again the question and read it. Payment to suppliers has the effect of reducing the creditors. So payment to suppliers, 6,400, we debit. Payment to suppliers, 6,400, we debit. It reduces the liabilities of the liability of the business. And then to the creditors, that is. Then total receipts from customers, that one we had captured. Discount received. It is the suppliers who give us the business discounts. And so discounts have the effect of reducing our liability to them. So discount received reduces the liability. Discount received reduces the liability, so it will be on the debit side. We've said anything that reduces liability of the creditors of the business is debited. So discount received is 520. 520. Then go to the next item. Discount allowed, we've tackled that one. Purchases, cash purchases, leave it out. We've said anything cash will not have a place in the ledger control account. So credit purchases has the effect of increasing the creditors. So credit purchases 15,200. Credit purchases 15,200. If it increases the creditors, you simply credit. If it reduces the creditors, you debit. Cash refunded from credit suppliers. Cash refunded from credit suppliers. Cash we had they had supplied to us possibly, and we paid them in excess. Remember, payments will have the effect of reducing. So when they refund, they are increasing again our liabilities. Remember, we are talking about the total creditors. So this will have the effect of increasing. Cash refunded from credit suppliers. Cash refunded from credit suppliers. That is 60. Cash refunded from credit suppliers. When we pay them, what happens? We reduce our liability to them. When they refund us, they are the ones who are paying us. So it becomes the opposite. So it simply increases. We are talking about one supplier possibly refunding us. So it will take the figure because his was an over. We had overpaid him to reduce. It had the effect of reducing the total credit amount. Now, what next? Return inwards, increase in return outward. Return outwards. It is us who are returning the goods back to them. So it means that we are basically reducing the liability because they won't charge us for what we have returned to them. So returned outward has the effect of reducing the liability. So return outward, what is the figure? 310. So we have 310 here. Then next, increase an allowance for doubtful debts, leave that one. Return inward, that one is for sales. Bad debts for sales. Contra settlement, we'll have this contra settlement. This contra settlement, you see it has the effect of debits, sales, credit, the purchases ledger. And how much is the figure? 850. I think we had explained this. So 850, like that. And then dishonored checks, that one is in the sales ledger. Interest on overdue, charge to debtors, sales ledger. Refund to cash customers, we chose to ignore that. And we're done. So we simply come here and get the totals. So the totals like that, the totals like that. So this will be, obviously you can see the credit side has the highest figure, and that is 15,200, 15,200 plus 800 plus 60. I think this is quite straightforward. This is 16,060. So this is 16,060. So here on 30th of June, we'll have balance carried down of, we add this side, we add the entire thing. So it's 6,400 plus 520 plus 310 plus 850. That gives us 8080 minus 16,060. Get the difference, this is 7980. So this is our balance carried down, which will also be on 1st July. It will be our balance brought down how much? 7980, like that. So that's how it is, and this is normally on 30th June. So that's how is it. That's how it is. The 7980 balance carried down, 7980 balance brought down, 7980. We are done. So this will give you 7 marks, and then the first part will give you the 6 marks. Thank you. Let's meet in the next question. If you've not subscribed, subscribe. We have so many of these videos, more than 100 actually, and they can be of help, real help, when you are discussing, when you are preparing for the exams. Thank you so much. Welcome.